All right, today we're jumping into one of the most powerful and honestly one of the most puzzling strategies out there in finance, momentum investing. I mean, this is a strategy that seems to fly in the face of everything we're taught, but somehow it's been working for almost 100 years.
So let's kick things off with a question that really challenges, the very foundation of investing wisdom. What if that fundamental mantra of buy low, sell high isn't the only way to win? What if the real winning strategy is actually to buy high and sell even higher?
And look, this isn't just some crazy what-if scenario. Back in 1993, a paper by two guys named Jagadish and Titman completely shook up the financial world. What they discovered was that a ridiculously simple strategy, just buying what's been going up and selling what's been going down, was consistently beating the market. It was like they'd found a glitch in the matrix, right? A direct shot at this core idea that markets are perfectly efficient.
And we're not talking about a tiny little blip on the radar here. The numbers are, frankly, staggering. When you look at the research, and guys like AQR Capital Management have done a ton of work on this, momentum strategies have, on average, delivered an extra 7 to 10% a year over the market. And that's for close to a century. So yeah, this is no fluke. It's a real, persistent thing.
Okay, so at this point you're probably thinking, wait a minute, if it's that simple, how does it actually work? It almost sounds too good to be true, right? So let's break down the actual mechanics of it. Well, at its heart, momentum is really just a disciplined three-step process. It's a loop. Step 1, you rank all your assets based on how they've done over the past, say, 3 to 12 months. Step 2, you buy the winners, the top performers, and you sell or even short the losers. And step 3, you just keep doing it. You rebalance the portfolio regularly to make sure you're always riding the current wave. Now, the timing on this is absolutely critical. If you look at too short of a time frame, like just 1 month, all you see is noise. Stuff just bounces around. But if you look too far out, like 5 years, things tend to mean revert. Basically, they go back to their average. So momentum lives in this kind of Goldilocks zone, this sweet spot between 3 and 12 months. That's where a trend really has the legs to run. Okay, but this brings up a massive question, right? If the markets are full of the smartest people in the world, all with supercomputers, why does this still exist? Why hasn't it been arbitraged away? Well, the answer isn't in the math. It's in our own psychology. So here's the bottom line. If you want to get momentum, you have to get human behavior. The whole reason the strategy works is because we, and yes, that includes the pros, we don't act like rational robots. It's our predictable human biases that open the door for this whole thing. And this slide, it just nails the difference between the textbook and the real world. The rational investor of theory, they see new information and the price instantly adjusts. Perfect. But the real investor, well, we tend to underreact to news at first. And then, once we finally catch on, we all stampede in the same direction, which just pushes the trend even further. You can pretty much boil it down to these 3 big behavioral biases. First, there's that underreaction to information we just talked about. So good news causes a slow, steady climb, not one big jump. Then you've got herding, classic FOMO, fear of missing out, where everyone jumps on the bandwagon. And finally, there's this weird quirk called the disposition effect, which is our bizarre tendency to sell our winning stocks way too soon, but hang on to our losers forever. All of this just feeds the momentum machine. Okay, so before you get all excited and start building your own momentum strategy, we have to talk about the dark side. Because every powerful strategy has a weakness, an Achilles heel. And for momentum, well, its weakness is a crash. And these crashes are sudden, they are violent, and they can be absolutely brutal. Yeah, this quote really says it all. You see, the biggest danger isn't that you'll just slowly underperform the market. No, the risk is a catastrophic reversal. When this thing turns against you, it can erase an entire year of gains in just a few days or weeks. It's a game of picking up nickels in front of a steamroller. Lots of small, steady gains, punctuated by these terrifying, huge losses.
And trust me, this is not just a theory. Take March of 2009, for example. The stock market hit its bottom and started this epic rally. You'd think that'd be good, right? Nope. Momentum strategies got absolutely demolished. Why? Because all the loser stocks that everyone was betting against suddenly came roaring back to life, and the recent winners stalled out. I mean, some momentum funds lost 40, even 60% in a single month. A single month! So what's going on here? How does that happen? Well, the main culprit is something called crowding. Think about it. When a strategy gets popular, everyone starts doing it. They all end up owning the same handful of hot stocks. So when the music stops, everyone rushes for the exact same tiny exit door at the same time. And that rush for the exit becomes a stampede, and the whole thing just implodes.
All right, so we've seen the incredible power, and we've seen the very real danger. Knowing all that, how can a regular investor even think about approaching this? Is there a smart way to play the momentum game? Okay, let's just be real for a second. For most of us, trying to do this by picking individual stocks is, well, it's really, really hard. You're constantly buying and selling, which means you're racking up huge transaction costs. And don't even get me started on the tax bill. Plus, it takes a level of discipline that most people just don't have.
A much smarter way to go about it for most people is something called the core satellite approach. Here's the idea. You put the bulk of your money, say 80%, into your core. Boring, stable, low-cost index funds. Then you take the other 20%, your satellite, and you use that to play the momentum game. Maybe you do it with sector ETFs. So if tech and healthcare are the hot sectors, you put that 20% into those ETFs. This way, you get a taste of that momentum upside, but your entire portfolio isn't going to get wiped out if there's a crash.
So when you boil it all down, the takeaway here is actually pretty simple. The whole strategy exists because of human emotion. It literally works by taking advantage of other people's fear and greed, which means the biggest challenge, by far, is managing your own emotions. I mean, it takes real discipline to buy a stock that's already gone up a ton, and it takes some serious nerve to hold on when the strategy goes through one of its terrifying downturns.
And that really leaves us with one final, crucial question to think about. Momentum preys on predictable human behavior. We know that. The real question is, can you be the one who doesn't get preyed upon? To win at this game, you can't fall for the same psychological traps as everyone else. The challenge isn't about outsmarting the market, it's about outsmarting yourself.